All right. And we know that it's been such a difficult year for small businesses, but many of us are optimistic about the future as the world starts to open back up. So, as you lead your business in its continued recovery, and you might be starting to look for some new opportunities, we're excited to offer a bit of trusted guidance today about lending. So, my team at AOF is really grateful for our strong partnership with the Small Business Development Center of Northern California. And I'm really pleased to introduce Kyle Roseman from the NorCal SBDC, who has generously agreed to share his expertise in small business lending with all of us today. So, Kyle, thank you so much for being with us.
Awesome. Thanks, Meredith. Thanks for having me. And I look forward to teaching everybody today a little bit about business lending and, to be honest, what I do on the day-to-day as a lending specialist and helping businesses work with lenders to get funded. So today's presentation is getting loan ready. And oops, sorry about that. First, I want to do a little introduction to the Small Business Development Center, who we are and what we do. We are a nationwide business consulting nonprofit. So all of our services are free. They're paid for by the SBA, by the American tax dollar, and some state funds, and local funds depending on the center. But we are literally scattered all over the country. This is our region in California, or the region that I work, specifically in Northern California. It's highlighted in teal. But you can see all those little dots are centers. So those are all the centers in California. And we're littered all over the nation. And we offer free business consulting and advising services, whether it's all sorts of stuff. HR, marketing, sales. I do funding and financing and lending. So there's a lot of tools we have in our quiver to help businesses succeed beyond just the funding. But I'm here as a lending specialist to talk to you about small business lending. So we have 1,000 centers nationwide providing no cost business advising. And one of the things that my center in Northern California is super proud of, our region has assisted with $50 million of capital injection just this year in 2021. So just in that little teal region, we've helped bring 50 million to businesses. And there are centers like ours all over the United States that are helping bring capital to the small businesses in their region as well. So as I said, we support businesses in a lot of different ways. It could be marketing, human resources, government contracting. There's a center called PTAC. I'm kind of forgetting exactly. I think it's procurement or something like that, but they specialize in government contracting. So yeah, we have a lot of advisors there to help you with a variety of business needs. And also sales strategy. So let's see, a big thing that I do is help connect businesses with lenders. There's a lot of different types of lenders, and not all of them have a very broad level of awareness. Everybody who's here today knows Accion, an opportunity fund. They're a great lender for small businesses. They're what's called a CDFI. A CDFI, and they're also micro lenders. CDFI is Certified Development Financial Institution. Not all of them, but some of them are nonprofit lenders. So they are basically mission-driven lenders there to provide capital to small businesses to promote economic growth and opportunity. They go into underprivileged neighborhoods and lend to small businesses. There's a lot of ways in which working with CDFIs can be, it's usually an easier process. They take on risks that lenders would typically not take. Loans that are typically considered higher levels of risk, CDFIs, microlenders will work with those. Then we have something called CDC, and the CDC is kind of the next step above a CDFI and a microlender. CDFIs and microlenders usually work on smaller deals. CDCs will do SBA lending. They're non-depository lender, and they will do SBA loans, and typically also work in spaces that seem to be a little bit higher level of risk. And the two things that, or these two lenders have in common, there's not a broad level of awareness on who they are. So when you come to the SBDC, we're really here to bring in our network of alternative lenders who can really help drive capital to businesses in ways that larger institutions can't. So I laid this out so that to kind of show lenders from the alternative space of being able to take on and manage a little bit more risk to lenders who take on less risk and more clean golden star deals that are less risky, but people often know more of those lenders than they do of the alternative ones. So we see that it goes from CDCs to CDFIs to CDCs, credit unions, local business banks, which usually now most people are familiar with. Where I'm from in Santa Cruz, California, we have a local business bank that's really strong, just simply called Santa Cruz County Bank. And they're a really awesome business bank, and they do a lot of business lending, but there are deals that they won't do. And so usually we can take those deals to a CDC or a CDFI, and they might be fundable through those lenders. The next tier would be a regional bank. So in California, that would be Bank of the West, US Bank, banks like that that are kind of regional. Maybe they're in multiple states, but they're not quite as big as the national banks. National banks being Wells Fargo, Bank of America, Citibank, and so forth. So a lot of people know about Wells Fargo, Citibank, Chase Bank, Bank of America. A lot of people are familiar with the regional banks in their area and even the local banks. And so lots of times businesses will walk into those banks hoping to get a loan, and if they get denied, they have no idea of where else to go. And the truth is, they still might be fundable. They just need to be talking to the right type of lender. So what I want to really talk with you about today is how we work with lenders to get your business funded. So what that process looks like, what kind of documents we need to collect and put together, what we're trying to communicate to the lender, and all the components of what we call the loan package. So a quick question. What are lenders looking for during the underwriting process? And if you guys want to just throw your answer to this in the chat, I promise this is not a trick question. The answer is a pretty simple one. So I'm going to pause for about 10 seconds and let everybody put that in the chat.
All right, looks like somebody says credit history, which I think makes a lot of sense. It's an important one. Ability to repay, feasibility of the business plan. Yeah, credit profile, which is kind of like credit history. Those are all great responses, right, Kyle?
Yeah, those are all great responses. And I heard the answer that I was looking for. Of course, they do look at credit history, feasibility of the business plan, all those things. But really the number one thing that they're looking for is our ability to repay the loan. This is what it comes down to. Credit history is a measurement of our financial integrity on a historical level. Feasibility of the business plan, yes, they're looking at that, but they're also looking at financial aspects of our lives too. And so we'll get more into that. I have one more question. How do lenders judge our ability to repay the loan? And I'm just going to go ahead and jump in and answer this one because I started to on the previous slide and I stopped myself. But basically, lenders look at financial and non-financial elements of our lives and businesses to determine our ability to repay our debts. So they're basically looking at our income. Do we have collateral? The feasibility of our business plan that was mentioned, our credit score and our credit feasibility, our credit history, how we've managed our finances in the past. But basically what it comes down to is they're looking at financial aspects and non-financial aspects. So if we take a look at the difference between the two, financial is, do we have income? Do we have a relationship with cash flow? Is there money coming in to our household or our business that can be there to pay the debt service, to cover the debt service? What debt do we have? Does the borrower have currently? Is that going to affect the ability of that person or business to repay? Obviously, we don't want to get in a situation where our current debt payments, let's say we have a couple different loans or we have some credit cards, we need to have more money coming in than going out. And so we look at that as one of the aspects. Do we have any collateral? We're going to talk about this more because in some instances, depending on the loan, it might not be a requirement, but this is something that a lot of lenders will look at, especially in loans that are over 100,000 or over 250,000. Collateral can become a requirement. And they're also going to look at, do we have cash on hand that's available as a reserve, as a security measure, so that if something happens where we have a little slip up one month, we actually have some liquidity where we can continue to cover the debt service. Non-financial aspects are the credit score. And I say that this is non-financial because it's not, there's a quality, it's a measurement of our history and of our financial integrity, but it's not specifically, do we have cash in the bank? Do we have income coming in? Do we have other debts or collateral? It's kind of a measurement of our character, so to speak, which is also another thing that they look at too. And connections to the industry. So we're going to really break this down a little bit later in the presentation, actually in the next section called 5 C's of credit. And I'm going to talk all about how these things fit together. But connections to industry is one of those qualitative characteristics that a lender is going to look at. That's really the feasibility of the business plan. Does the business have connections to the industry to make their vision come true? All right, so the components of a business plan, let's talk a little bit about this here. So when you come to the SBDC, or when you walk into a bank, or when you talk to Opportunity Fund, one of the things that we're going to do is create a financial package. And this package is used by the loan officer to basically go pitch the loan to their credit committee and say, this is a good loan and we should do this. And so in order to do that, they need to collect a number of documents. So one of them is tax returns. And the reason why is tax returns provide proof of income, and typically we'll collect the previous years. So maybe 2 or 3 tax returns so that we can see historic income and what the trend is in the business. Is it growing? Is it decreasing in sales? We're trying to really gauge where the business is at and what the story is. And we can see that a lot through taking a look at this particular document in the tax return is Schedule C, and it shows all the income and all the expenses. And through that, we can kind of see what the business activity is. That's where there's some interpretation and financial analysis. And of course, we also gain an understanding through talking to the business owner. But we take that story that we hear from the business owner, and then we look at the taxes and we try and see, is everything meshing? Is it all true? Is it all running together in in a good way. Taxes are also a legally binding document. So everything on a tax return is certified as true. So this really helps lenders make sure they're making the right decision, because a P&L that a profit and loss statement that is created on Excel or on QuickBooks, typically those are true, but they could also be not true, not entirely honest. If there is somebody who is looking to get a loan, they could like fudge their numbers a little bit. And typically, tax returns are a legally binding document. They're true. So that's what lenders go for, because lenders are all about offsetting risk and finding the real situation. And so typically we use tax returns. Although when it comes to the current year, if taxes are not filed yet, then we will collect what's called the year-to-date financials, which will be a profit and loss statement and a balance sheet. So a balance sheet, as I just mentioned, balance sheets are a little different than a profit and loss statement or the tax document that we just looked at, because they show assets and liabilities. They're going to show how much cash is in the bank. They're going to show how much value is being held in equipment or in inventory. They're really going to measure the assets versus the liabilities and show the net worth of the business, which is a little different than a profit and loss statement. Actually, it's quite a bit different than a profit and loss statement or the tax return, because what that is showing money that's coming in or leaving, income versus expenses. Profit and loss statement is income versus expenses. Balance sheet is asset versus liabilities. Okay. So as I just said, it shows current assets and cash on hand and equipment and all these things, current liabilities. So there's some more documents that we look for. We want to collect the year-to-date financials of the business. So that's a current income statement or profit and loss. Those terms describe the same document. We also want the current balance sheet for the year. Oops, sorry. And we're basically collecting all these documents to gain a financial picture of the business and see where they're at and if they're fundable. Other documents we're going to collect are the financials of the individual, the business owner. So we want to see their personal tax returns to see what their household income looks like. In lending, what happens is first we look at, can the business pay off the loan? Is there enough assets in the business? Is there enough revenue in the business to really just underwrite the loan on the business? And then we also typically look at the business owner and what their household looks like. How much income they have coming in? Do they have collateral? Do they have cash on the bank, in the bank, and stuff like that. We also are going to collect a personal financial statement. This presentation talks a lot about microlending towards the end. That's the main example that I go through. And so for microloans, typically we might not collect a financial statement, but we will ask for possibly bank statements. It really kind of depends on the lender, but for larger loans, the lender will typically ask for a personal financial statement. And this is basically the same thing as the balance sheet for the business. It's assets versus liabilities. And it also, there's a little section here that asks for income. It's basically the whole financial picture of the individual: assets, liabilities, income. It's going to ask you to list out your liabilities. And this is really to gauge the capacity of the individual. All right. So far, we've collected tax returns and we've collected profit and loss for the business. We've collected a balance sheet for the business. We've collected personal tax returns, sometimes a personal financial statement, and for sure a credit score. So the credit score or the credit report shows the financial integrity or responsibility of the borrower in question. And it's going to go back about 24 months. Typically, credit reports go back 2 years, and they really look at how you've managed your assets, your credit, and have you made good decisions. And there's this weighted score that was created out of Stanford way back. I forget exactly when, it was like 100 years ago or something like that. And this is basically an industry metric. Not all lenders use the FICO score. Most lenders do. And in the micro lending space, actually, I work with a lot of lenders who don't weigh their decisions heavily on the credit score. They will actually pull a background check, and they just want to make sure that the person that they're lending to doesn't have an extensive criminal history. And so they're really looking at character in that way. But of course, they also want to see that there's not any real toxic debt on the household of the business owner. And the last thing that we're going to ask for is a statement of use. And I put it last in this presentation, but typically this is the conversation that happens first, right? You have a request, you're looking for funding, and you're looking for funding to do something. So typically we walk in to a bank, or we have a meeting with a lender, and we sit down with them and we really talk about who we are and what it is that we're trying to do. And so this statement of use is an explanation of the capital need, how much you want and what you're going to do with it. A line item budget of purchases that you need to make could be part of it, and an explanation of the operating capital need, the reason why you're borrowing money. This doesn't always have to be in a written statement. It can be something that's verbally communicated. It really kind of depends on the lender. Depending on the complexity of the deal, if it's a really big expansion that has different moving parts, the lender might really want to see something in writing. If it's really just to purchase equipment, it could just be a line item budget. So it really kind of depends. Not all lenders will ask for something in writing, but some lenders do. And then also what I like to help my clients do is an explanation of your connection to the industry. And you'll see what I mean when we go into some of the examples that I'm going to talk about later in this presentation. So I know all this kind of was a lot of different documents, a lot of different requirements. So I wanted to summarize it all up. This is what we're looking for. We're looking for tax returns for the person and the business. We're looking for year-to-date financials, balance sheet, income statement of the business. How are things right now? Because taxes look at previous years. We want a personal financial statement to understand the household financials, assets versus liabilities. We want typically a credit report, sometimes a background check, and a statement of use. And all these documents is really what goes into a loan package. This package, the loan officer will go through it, and they take it to their credit committee and they sell your loan. So first, you're selling your loan to the loan officer and telling them why it's such a good idea that they lend you money, how strong your business is, how strongly your business is connected to the community and the services you provide, and the value that your business brings to the community. And then the loan officer is going to go through it, and they're going to say, okay, all right, I think we got something here. And then they're going to go to their credit committee, and then they're going to sell your loan in order to get the approval. So this is what a loan package looks like. What I want to talk to you about in this next section is the 5 C's of credit. And the 5 C's of credit is basically the way we structure the conversation around lending. So learning the language of lending. How do lenders talk? What are lenders looking for? It really kind of revolves around these 5 different things. The 5 C's are cash flow, collateral, capital or cash on hand, credit score, and connection to market. So I'm hoping that you can kind of see where the dots connect here from the loan package, right? All the documents that we just collected are really trying to touch on this structure of conversation through the 5 C's: cash flow, collateral, capital, credit score, and connection to market. So the 5 C's outline our conversation with the lender, right? Key point being our ability to pay back the loan. This is what lenders are looking for. They work with a diverse range of businesses, and all of them are interesting. All of them are unique. And the bottom line for lenders is they want to know each business's ability to repay, whether it's coffee house, whether it's a landscaping business, whether it's some sort of scientific research center. It all comes down to the borrower's ability to repay. So I just want to run through all these C's with you. Cash flow. Do we have the income to make the payments? Income versus debt. Typically, lenders will ask for what's called a schedule of liabilities, which is basically a list of all your debts that you have. This could range from some credit cards, one credit card. It could also be an auto loan. It can be your mortgage. You're basically just listing it all out. Then they're going to look at your income, and they're going to measure this ratio of debt to income. And they're going to do this they're going to start with the business. And if it looks like the business might need a little bit extra help from the business owner, then they're going to tie in the owner's financials. And what that's called is a global financial analysis. So global meaning business and business owner financials come together in order to hold up the new debt. But first we look at the business and we look at the business owner. Kind of just talked about this, but after we subtract the current debt service from the borrower's income, there is a remaining amount. Does that amount cover the new payment in question? Okay. Of course, we're talking about the ability to repay. So after cash flow, we have collateral, which is a second source of repayment. Typically, lenders want real estate for collateral. There's not too many different options for collateral. There's real estate. There's a whole life insurance policy could be used as collateral. And what they're going to look at on that is the cash value of it, the cash surrender value for the whole life insurance policy. That can be used as collateral. Cash is not used as collateral. And when I was first getting into this kept coming up for me because I had people who actually had cash in the bank, and I was still not quite able to get their loans approved because maybe lack of income or the feasibility of the business plan, or it was, something was off. And I kept talking to my mentor about it and saying, what the heck, they have all this cash. Why isn't that just getting them approved? And he used to say to me, well, Kyle, they can spend it right after they get the loan and then it's all gone. So collateral is really something that's not totally liquid, that a bank can basically slap a lien on and say, okay, until you pay off this loan, we're going to have a lien on your house or on your insurance policy. And that's basically, a risk measure that the lender uses so that their loans don't go bad. In collateral, I just wanted to touch on this again. It's not always a requirement, typically not required for microloans under 50,000. Microloans are kind of this friendly space for small businesses. If the capital need is under 50,000, it's a pretty nice space to play in. So capital, third C, cash on hand. Just talked about this, but I'll say it again. Although cash on hand won't in itself make someone fundable, it will definitely help someone's chance of approval. So if the other C's are also looking good, cash on hand can be that point that really just sells the loan. They have income, they have collateral, they have pretty good credit, their connections to market are okay, but they also have X amount of dollars in the bank for a rainy day. This can really be something that can just be that last push that a credit committee might need in order to approve a loan. Credit score and background check. So we're measuring the character of the person. Background checks are usually involved with loans that are not heavily weighted on the credit score. So in the micro lending space, we will see it's common that a background check will be a requirement of the loan. And they will pretty much always pull credit, but it's not a factor that plays heavily on the loan. What will play heavily on the loan is this person already swamped in debt? That will play a factor and really make the lender kind of ease off a bit. But if their credit score is a little iffy for other reasons, maybe they just never really built it, which we kind of see a lot, then really what they want to look at is background check, and hopefully the borrower does not have an extensive criminal record. Credit scores are meant to represent the financial responsibility of an individual, and the background checks are really looking at criminal behavior. So both reports are used to measure the borrower's integrity. Connections to market. Lenders want to know what your opportunity is. How strongly are you connected to your industry? The likelihood of your success. This is also usually communicated through the use of funds statement. The use of funds statement is not necessarily a long document. It could just be a page or less even. So we're going to talk all about that in this next section, which I really want to jump into because I don't want to run out of time without going into how this stuff all really ties together. So we're going to talk about the use of funds statement and your connection to the industry. Really what I'm talking about in this section is an example for you to see here the conversation between a borrower and the lender. All right, so let's start with the use of funds statement. The purpose of the use of funds statement is it communicates the capital need. Could be a line item budget. It also communicates the opportunity. Explanation of what you're trying to achieve. What's your vision? Why do you need money? Like, what are you trying to achieve? We really want to communicate both these things in the use of funds statement. So the budget and the vision that you have, that the whole reason behind why you need money in the first place. All right, so I'm going to jump into this example here, and this is really to show you kind of the thought process of how loans get underwritten and how we talk about businesses kind of behind the curtains. So I want to talk to you about this business. I totally just made this up. Expansion from a retail coffee shop to a product line. Frothy Cathy's Coffee House, okay? So Frothy Cathy's has 2 retail locations. What I mean by that is there's 2 coffee houses, and they've been in business for a little while, and they're basically looking to create a cold brew product line to bring to breakfast shops, grocery stores, and local markets. And they're looking for a loan to create this new product line. capital need. So the cost per unit for these little cold brew coffee drinks is $1.50. Okay. Kathy is looking for capital to fund the first 2 productions. Each production is going to be 10,000 units, so 20,000 units total. So she needs about 30,000 in capital. So let's take a look at her business. Through her taxes, we can see that in 2020, the net profit was 4,300, which was a little lower than 2019, which was 12,500, and 2018, which was 11,700. So let's figure out what's going on here. I kind of threw that in there to see if anybody would understand why in 2020 the revenues or their net profit might be lower, right? Hopefully everybody's thinking COVID. So business profile. Frothy Cathy's Coffee House has been in business since 2015. We've grown a local following due to our quality beans that we order direct from a farm in Ecuador. We roast in-house, and our 2 retail locations have become a cultural hub because we bring live jazz bands Friday night and Sunday mornings. Frothy Cathy has an interest from a local grocer to bring in cold brew products to their 3 locations, as well as 2 other markets that are close to the beach and sell other artisan craft goods. Our brand has a local recognition and a customer loyalty. In 2020, the business took a 31% hit in revenue because the pandemic forced us to close our doors and we were unable to provide the live entertainment. However, we kept our window open and served our customers while maintaining pandemic health code guidelines. So you can see this is a quick business profile that just goes straight to the chase. Talks about their history, talks about their strength to the community, talks about why they had a dip in revenue in 2020 because of the pandemic. It talks about how they handled that situation. And so this is a business profile, okay? So now we're gonna look at the owner, Kathy. Personal income, 2020, 39,000, 2019, 45,000, 2018, 43,000, okay? So if anybody's curious about how this is her income and versus the net profit of the business, in this typical situation, or in this example, I was making the assumption that she was being paid W-2. So these numbers on the business net profit are after her compensation, okay? And I also made the assumption here that in 2020, her income was covered by the Paycheck Protection Program, so there wasn't a huge dip in her income. There was a little bit, about 6,000 from the year before, but she still had income. Okay, assets. What does she have here? She's got 25,000 in a savings account. She's got 100,000 in a retirement account, and that's it. She's a renter, so she doesn't own a home. Liabilities. She's got $8,000 on a credit card. She's got $20,000 in an auto loan, and she pays rent, which is about $1,700. All right. And her credit score is 690. So we've seen the business profile. Now we're looking at the owner's profile, and we're going to see how it all fits together. So quick recap, or kind of quick left turn here. We're going to look at these types of loans that she's going to look at. There's a COVID recovery loan that she could get, or there's a typical micro loan. So she's looking for 30,000. COVID recovery loan, what I've seen in the marketplace in California, and I know this presentation is going across the United States, but basically what we have in California, there's the California Rebuild Fund, and these are the terms. It's 4.5% at 5 years. So the monthly payment on that is $560. The annual payment, 12 months of debt service, is $6,712. typically on a COVID recovery loan, there's this requirement that although the business cannot be completely devastated and totally unable to recover, they do want to see that there was an impact. And the impact that they're looking for is that there's a 25% drop in revenue during the pandemic. And we know from the business profile that Frothy Cathy had 31% drop in revenue, but she's still ticking, she's still cruising. And so I threw that in here because in the real world, this is probably what I would help her get, is this COVID recovery loan. However, I also wanted to show everybody what a typical micro loan would look like. So that would be 30,000, probably around 9%. It'd be from like 6 to 9%, depending on the risk of the deal. 5 years, and these are the payments per month would be 623, per year would be 7,473. All right. So we're going to take all of this and we're going to plug it into the 5 C's. All right. So let's look at cash flow. So cash flow, we're going to calculate something called the debt service coverage ratio. Okay. And that's where we take the net income and we divide it by the debt service, and we're going to get this ratio. And what we're going to want to see is that ratio is a number that's greater than 1. And I'll show you why. Okay. So in 2020, net income, $4,300. The debt service is 6,712, right? So the coverage ratio is 0.64, meaning there's not actually enough income in 2020 to cover this loan. So it's under 1. All right, let's look at 2019. 2019, there's a net income of 12,500 divided by the 6,712 annual debt service. We're going to see 1.86. This is really good. Typically, we want to see a 1.25. That's kind of the lower end at 1.25. Anything above 1.25 and even 1.25 itself means that there is enough cash flow to cover the loan. And that's typically what we want to see. So 1.8 is really good. All right, we're going to go back even one more year, historic cash flow, and see how the business is historically. Would it be able to cover the loan? So we take that year's net income, 11,700, and we divide it by 6,712, and we get 1.74. So historically, she's looking pretty good. She just had this dip in 2020. So this COVID recovery loan would be a pretty awesome choice for her. And again, they're going to want to really dive into the feasibility of the business plan. But in her business profile, she did talk about her connections to market. She talked about the grocery stores that want to bring in a cold brew product line for her, and as well as a couple other markets in her neighborhood. So collateral, she doesn't have any. They will require a personal guarantee, but there's no collateral on this loan. It's not a requirement. It's under 50,000. It's a micro loan. The capital, she has 25,000 in cash savings in her bank. So this is something to keep in mind. And it kind of ties together there with the personal guarantee. Credit score, her credit score was 690. Connection to market, 5+ years in operations, and there's a demand for a retail product line. Okay, so basically there's this big initial conversation that we have. There's this process of putting together the whole financial package, the loan package, and really we're trying to take all that information and funnel it down into something like this, something that talks about the 5 C's, and really see, does this loan make sense from the side of the lender? And in this case, I think it does. I think it would. And so that was kind of my goal, was to show you a success story. And this is one. So lending decision ultimately depends on the lender and their requirements, right? Every lender is different. Even CDFIs, some of them are startup friendly, some of them are not. Each one requires different things. So going to this example, in this case, the lender will probably ask for sales projections with a brief explanation. I did not talk too much about that in this presentation today, but yeah, sales projections with an explanation would probably be required for Frothy Cathy. Cash flow is good in previous years, but not during 2020 as a result of COVID. That's why she would probably go with a COVID recovery loan. Owner's cash on hand may play a part on the decision. And typically microlenders do not require collateral. So yeah, I hope this was a good example that really enlightened everybody who showed up today on how loans are underwritten, what lenders are looking for, and how that conversation kind of happens. So just to wrap things up, we have a variety of different lenders, and some of them are easier to work with. I'm going to list them out again from kind of easiness to work with and lack of awareness and by most businesses to hardest to work with and most awareness by business owners. So CDFI and microlenders, typically not a lot of businesses know who they are. They're also typically the easiest lenders to work with, followed by CDCs, followed by local banks, credit unions, regional banks, and national banks. As I said, pretty much everybody knows who Wells Fargo, Citibank, Chase, and Bank of America are. There's not a lot of people who don't. Not everybody knows who Opportunity Fund is, who TMC financing is, who Small Business Finance, CDC, a lot of these lenders who fall under the CDFI or the CDCs, not a lot of businesses are really aware of them. However, they are the easiest lenders to work with. And that's why the SBDC is here, is so that we know what lenders are out there, who's doing what, who's easy to work with. We have relationships with lenders so that we know what deals to send to who and really be this connection point between businesses and lenders. So I just want to go over a couple of things in this presentation. What are lenders looking for through the underwriting process? Our ability to repay the loan. Pretty straightforward. How do lenders determine our ability to repay? Through the loan package. Okay? Income requirements. They look at our taxes, collateral, cash on hand. They look at our personal financial statement. They're going to look at our credit report. They're going to look at the business opportunity and what we're trying to achieve. The 5 C's in the language of lending: cash flow, collateral, credit score, capital, cash on hand, connections to the industry, our opportunity. This is what I was trying to drive home today, was the 5 C's, the use of fund statement, how to talk with your lender, and the different types of lenders that are out there. I hope you got a lot out of this today. And if you need more information, do not hesitate to reach out to your local Small Business Development Center or Accion Opportunity Fund. If you're here today, it means you're in good hands, because Opportunity Fund does a lot of good things for the businesses in their network. And with that, if we have any questions, we have about 10 minutes. And thank you all for coming today.
Great. Thank you so much, Kyle. I think it's so important to understand how a lender would be assessing the business. And so I think that's why the 5 C's are so important for business owners to kind of think of themselves as the lender will. So I really appreciate you walking through all the details of that. I just think it's really, really helpful. So like Kyle said, any questions that you all have, we're happy to answer them. I know we had a couple of questions come in to the chat, but feel free to type some more in. We got a few minutes here, so we can go through some of these. So one question that Melvin had that I think is good is about how the tax return or the profit and loss statement might be kind of an incomplete picture of what the business's financial situation really is. So the example that Melvin gave is if a business is really, really pushing on marketing, spending a lot on marketing, it might in the short term look like they're taking a loss, even though it's going to long term boost sales. And so you might not get the whole picture with that one statement. So do lenders look at kind of multiples, or in the example you shared about Frothy Cathy, kind of looking at multiple years to get kind of a whole picture there?
Yeah, 100%. So there's a lot of information on a profit and loss or on the taxes. Let me see if I can just pull that slide up. And it's one of the things that the lender will get, or even myself will get, just by looking at a document like this. So there's a lot of stuff going on here. So there's a company in question. They are investing a whole lot in marketing. And therefore their bottom line, their net profit might be impacted by that. So other things that we're going to look at is the gross revenue. And we're going to see, okay, what's the trend for the gross revenue? Because that's going to show how much business the business is actually doing. And then in a profit and loss, we're going to see all sorts of different, all the expenses are going to be laid out there. So if the business owner says, yeah, this year we've invested a whole bunch in marketing, we're actually going to see that on the P&L. So that will match, that verbal communication will match the P&L document. Other things that I can see by looking at somebody's tax return is certain things like depreciation will be on there. And so if depreciation is on there and it's higher 1 year, then what that tells me is that they invested in either equipment or real estate. And that all of a sudden that 1 year, they invested in equipment or real estate, and so they wrote off a bunch of depreciation. So when we look at the P&L, we're not just looking at the net profit. We're actually looking at all the activity that's happened. And somebody who really understands financial analysis knows how to look at a P&L and kind of assess the activity that's actually happening within the business. So, and if it's followed by communication from the business owner, then all the better.
Yeah, absolutely. I think that makes so much sense to be able to see kind of the whole picture instead of just this one bottom line number. And that's what you want your lender to look at, is all those activities. Great. All right. All right. So as folks are putting more in the chat, just want to make sure to remind you that we're recording the presentation. So we'll send out the recording within the next 24 hours so you can review any of this information at that time. So we'll send you the link. All right. And then we had a great question from Lakeisha. So about grants versus loans. So today we've been focusing on getting ready for lending, but just wanted to touch on this because we had a couple questions come in. If grants are available, which a lot are, have been over the last year because everything has been so difficult because of the pandemic, if grants are available, would it make sense to apply for a grant before applying for a loan from sort of the financial profile perspective or the credit history perspective? What do you think about that?
So I don't think that grants will have any impact on credit. I don't even know. So I wasn't actually a huge player in a lot of the grants that were coming out, but I don't think that they pulled credit as a part of the grant process. So there shouldn't have really been any impact on credit. I mean, I would apply for the grants no matter what. If there's an opportunity there, I would just apply for it. What I did notice in California with our grant is that there was, one company that was rolling out the California grant program, and their resources were limited. And so their ability to respond to the applicants was seriously limited because we had like millions of people apply for these grants. And a lot of them are frustrated because there wasn't any communication between the grant administrator and the applicant. So, I would recommend that everybody apply for the grants, but when you when you apply for a loan, it's going to be quite a bit different because there's a different relationship there and it's a lot more intimate, and you can talk to your lender and you communicate things, and the whole process is a conversation, and that doesn't really happen with these grants. The grants are really, it's just like a process of application, and then who knows.
Yeah, absolutely. I think you're right. Why not apply for free money, right? It's not, it doesn't hurt, but it's a bit more transactional, I think, because there's just overwhelming number of people applying for them. Um, and there's so many different kinds of grant opportunities. And so, but I think the same as you, I can't think of one that has taken credit into account, like of all the different opportunities. The thing is, it doesn't build credit the way repaying a loan would, but you don't have to pay anything back. It's free money. So it's kind of deciding which thing makes the most sense for your business at a time, I guess.
Yeah.
All right. Well, it looks like it's the top of the hour, so I want to be respectful of everybody's time. But Kyle, I really appreciate you spending this hour with us and explaining all of these really important pieces. And thanks everybody who's on the line for spending this time with us and investing in your business by learning. We really appreciate everybody joining us today. Thanks for sharing, and we'll see you at the next webinar.
Awesome. Thank you so much.